In this video, I will explain a stock investment strategy for the Fortune 500 company Vistra, invested with a time horizon of just under 2 years, at 22 months, that generates hedged income of 15% while affording upside potential of 60%. Vistra is a $48 billion power generation company that sells electricity to end users, increasingly also to data centers in the AI space. Keep in mind that this video is for educational purposes only and does not constitute investment advice. The strategy that I like for certain client accounts as part of a well-diversified portfolio is for a 22-month investment horizon and generates hedged income for that time period of 15.3% in exchange for capping upside share appreciation potential to 59.7%. Throughout this investment horizon of 22 months, the expected dividends for the stock should be 1.1%. This means that the total potential return for the strategy is the sum of hedged income, 15.3%, plus dividend income, 1.1%, plus capped upside potential of 59.7% for 76.1%. This means that irrespective of how much higher the stock may be trading by hedge expiration after 22 months, the total return is capped at a maximum of 76.1%. The benefit is that if shares are unchanged after 22 months, then instead of just keeping the dividend of 1.1%, this strategy generates that 1.1% dividend income plus the hedged income of 15.3%. Additionally, for US residents, because this investment horizon extends beyond 1 year, the income received, the hedged income, is taxed at a lower rate for long-term capital gains and is taxed advantageously. In the event that the shares fall after 22 months, then this hedged income received of 15.3% serves as a buffer of downside protection, meaning that the stock would have to fall more than 15.3% over 22 months in order for loss exposure to begin. The stock has actually been quite volatile over the past 2 years based on the market trying to ascertain the amount of AI, or artificial intelligence, exposure that the company has to end users to sell its electricity. 2 years ago, the stock was below $100 a share and then moved significantly higher to almost $200 before falling below $100 based on the tariff sell-off, and then rapidly moved up to above $200 a share based on enthusiasm for that AI end user demand. Since then, the stock has fallen down to the current level of $145 based on that AI demand not necessarily materializing to the degree that was anticipated to date. I'm not big into charts, but looking at the chart here, the stock has been trading in a sideways pattern, which looks like an accumulation pattern. And I actually like the chart from a technical perspective, but I'm more focused on fundamentals, so let's take a look. On an earnings per share basis, the company is expected to grow earnings in 2026 to about $9 a share, and then sequentially grow earnings roughly 10% a year thereafter. Now, at this point, total AI demand is less than 5%. The market has priced in the past a lot of enthusiasm for an increasingly large percentage of AI demand. With the stock trading at $144 a share, and with earnings next year expected to be roughly $11 a share, the company only trades at 13 times forward earnings, which is really attractive. So at this level, my interpretation is that the market is pricing in marginal AI demand growth, and if that AI demand growth does materialize to a degree that was anticipated to a greater degree a year ago, then that's just upside for the stock going forwards. Wall Street analysts who cover the stock are bullish or optimistic on where the stock should be trading at. The target price range based on Wall Street analysts ranges between $187 and $298. Let's just rip through this list really quickly. So Wells Fargo thinks the stock is worth $212, UBS is at $227, Morgan Stanley at $212, TD at $222, Scotia at $298, and Bernstein at $187. So with the stock trading at $144 a share, analysts think the stock is worth quite a bit more. Personally, I think that if things get bad in the market, the downside from 144 is probably closer to 120. If things get really bad, probably you look at maybe a quick touch to 100 with a rebound thereafter. Let's get back to this hedged income investment strategy, which is a pure play covered call. So a covered call consists of buying 100 shares of stock and then selling a call option at a strike price and receiving income in exchange for doing so. So selling a call option is selling away the potential for your unlimited upside by capping your total return potential, and in exchange for doing so, you receive income. So this covered call chart consists of implementation at August 10th, 2026, buying 100 shares at the market price, which is $144, and then going into the options market, which in this case is out to June 16th, 2028, 22 months from now, just under 2 years, and selling a call option at a strike price or maximum selling price of $230 a share. So buying the stock at 144, this strategy caps your maximum upside at option expiration to $230 a share. In exchange for capping your upside at $230, you receive income of $22 per share. This is what the investment income profile looks like. So the first step is to buy 100 shares at the market price of $144. The second step is to sell that call option expiring in 22 months at a strike price or maximum selling price of $230 and receiving that income of $22 a share. This means that come option expiration in 22 months, if shares of the stock have fallen, the downside break-even basis is $122 a share. That's a 15.3% decline from where shares are currently trading. The hedged income, the income received for this, is that 15.3%. That's the income of $22 per share. The upside potential for this strategy is 59.7%. The maximum potential return, excluding the expected dividend to be received, is 75%. So this strategy is really advantageous if you think that the stock may have a bit of downside exposure, may trade relatively flat, or even has quite a bit of upside potential, but not unlimited upside potential above that strike price of $230 when the stock currently trades at $144. Let's take a look at scenario analysis for what might potentially occur at hedge expiration in 22 months. So if the share price of the stock, currently $144, is unchanged after 22 months, the stock return would be 0. However, the hedged return would be 15.3%. In the event that the stock falls, say it falls 9.7%, well, if you just own the stock, excluding dividends, you would lose 9.7%. But with this hedged strategy, you would actually generate a profit of 5.6%. If the stock falls 16.7%, then the hedged return is actually a loss of 1.4%. This should be red. But if the stock falls 16.7%, you'd lose 1.4%. If the stock falls 23.6%, then you would lose 8.3%. In the event that the stock rises, say the stock rises to $150, just a return of 4.2%, well, this hedged income strategy generates a return of 19.4%. As the stock moves up to that maximum selling price of $230, there is a commensurate increase in the hedged return. So if the stock rises 59.7% to $230 by hedge expiration, then the hedged return outperforms the stock ownership only strategy by generating 75%. If the stock continues to rise, then the stock return would continue to rise, but the hedged return is capped at that 75% rate of return. Keep in mind that this video does not constitute investment advice. All client portfolios are customized with diversification and portfolio weights and strategies that are tailored for each individual client. This strategy is appropriate for some clients and has an appropriate percentage of a diversified portfolio. If you'd like to learn more information about hedged stock investing from our fiduciary financial advisor firm, Bespoke TFC Capital, then go to our website at bespoketfc.com. If you'd like to see portfolio examples with different strategies and different dollar amounts, then in the top right-hand corner, click Insights, and then you should see different portfolio examples with various dollar amounts, or go to bespoketfc.com/insights. Thank you for watching today. Like and subscribe, and hopefully we'll see you in the next video.